Hello, are you one of those people who knows exactly how much they're worth at any one time? Or does money burn a hole in your pocket? Would you like a lovely home or perhaps a posh car like this? Well, we can't promise you either of those two things, but this video will tell you how to make the most of what you earn and how to cope with everything from winning the pools to the financial horror of losing your job.
As you go through life, your financial needs change. So just as you think you've got it cracked and you understand what you need at this stage of life, you suddenly realise things have changed. Maybe you've had a child, or maybe you've got to a certain age and you're beginning to worry about whether you've got enough pension or something. And each time there's a whole range of products and topics and tax things you need to find out about, and it feels so complicated that people sort of start by blanking it out in a way.
The temptation of the materialistic society that we're now in is to go out and spend, in many cases overspend. The trick of personal finance is to try and hold the balance up, to try and recognise the fact that life is a long piece of string, and if you cut it off at the beginning, you won't get to the end.
It's not funny at 50 or 60 or 70 or whatever to find out that if only you'd done X and Y when you were younger, life could be so much pleasanter for what would at that stage have been very little cost. Tell me about the meeting.
Oh, I thought you never asked.
Simon and Sarah enjoy the high life, eating in nice restaurants, reaping the rewards of their hard work. Simon also likes living now and paying later. Not for him the hassle of hard cash. He pays with plastic wherever he goes.
Right. That's fine. Can I give you that? Yes. How much is it? No, don't worry about it. Okay, thanks a lot. Don't worry. It's all right. It's taken care of.
Money is a very peculiar commodity. We spend every working day of our lives trying to get it. And when our working day is finished, we try very hard not to spend it all. It engulfs everything that we do, it's related to everything that we do, and we all are in the pursuit of more of it. The trick with money is to hold on to as much of it as you can, and yet to enjoy it. It's an extremely difficult balance to maintain, and the wisest of us all haven't actually perfected it yet. The main thing is always to try and keep out of trouble, not to overextend, not to overborrow, not to overgear.
That, sadly, is precisely what Simon and Sarah have done. They've bitten off more than they can chew. They think they're nicely set up in their own home. But as well as spending too much, they fail to prepare for a rainy day. And in this morning's post, as well as the usual bills, there's devastating news. Out of the blue, Simon has lost his job.
What is it? What is it? What is it? What is it?
If your situation suddenly changes and you find that you're absolutely unable to manage your finances, the first thing that you've got to do is know what your budget is about. A lot of people never have a budget. They've never actually worked one out, and they sort of live day to day. But it's crucial. It's something you'll need all your life. So you need to know what your income is, where it's coming from, and whether you can maximise it. Are you getting all the benefits you're entitled to? Is your tax code right if you're paying tax? And are you getting all the amounts that you could get from other members of the family and so on? And you need to know what your day-to-day outgoings are. Now, by day-to-day, I mean the sort of life and death things that don't change very much, like your rent or mortgage, your electricity and gas bills, your food bills, your fares, cigarettes if you smoke. All of those things have got to be included. The things that you're spending money on every week.
People tend to panic about their credit cards. Actually, that's not a very important debt. because you can write to your credit card people and say, I've got this problem, this is the money I owe left, right and centre, I'm now out of work, all I can afford to pay you is 10p a week for the rest of my life, and the chances are they'll accept that. As long as you've made an offer of some kind, they'll accept it, and they won't chase you. But if you don't know that, you think, my God, I owe my credit card company £1,000, what am I going to do? It's actually a very low priority debt.
Well, the best way to do it is actually to write to the credit company and say, I don't want any further credit. I'm not going to use this card again. Here it is, chopped up. And I'd like to make an offer of repayment on this, based on interest being frozen. Now, his girlfriend or partner wouldn't be liable for those credit debts, so long as she never signed any of the agreements. However, generally speaking, creditors will look at a joint financial statement because in the end it could affect her property in the home. For example, if he didn't deal with his debts and it got to court action and it still wasn't dealt with, then bailiffs could come into the home and they would view most of the goods in the home as being joint. So it's very important that he deals with and lets people know straight away. He may need to go to an advice agency, like Citizens Advice Bureau or some other agency, to help with negotiating with those creditors. But they must know that he's now going to be on benefits, or what his income is going to be. They also need to be told the extent of his indebtedness. And one of the things is that when people are using credit, they don't view it as a debt until they can't pay it. And so they view that they're just using credit, and it becomes a debt just by the very fact of the redundancy.
What Simon has to work out is what's the best move he can make to keep the credit card companies off his back while at the same time saving his house. He also has to check which debts he should pay first. Whichever move he makes, he could face an uncomfortable and very different lifestyle.
If you sell your home and you've got equity, then you may be able to go and do something else, or you may be able to rent accommodation and then get housing benefit for that rented accommodation. If your situation is that your house is worth less than the mortgage outstanding, very unlikely that you'll be able to sell that property, and you will be caught in a negative equity trap. There are situations where if there's some equity, you may be able to find that changing the type of mortgage that you've got is helpful. For example, some of the high street lenders at the moment are offering quite good deals on fixed rate mortgages at about 7%. It may well be that somebody's paying at 10%, so by changing their mortgage and speaking to their lender, they may in fact have lower repayments which they can then afford, so that's one other option for them. If his partner is working full-time, he may not be eligible for income support, because if one or more of a couple is working more than 16 hours, then he won't be eligible for income support. He may, however, be eligible for unemployment benefit, depending on the contributions that he's got from previous years.
So it seems that Simon's best hope of keeping his head above water lies on the cards pinned to the board here at the job centre. Simon needs work, and he needs work quickly.
Can I help you at all, sir?
Yeah, you can actually. I'm not quite sure what to do. I've just been made redundant,
Right.
and I just came in here really to see what I have to do. I want to get another job as quickly as possible.
This is all new to you?
Completely.
Right,
Yeah.
so would you like to come over and I'll
Yeah.
give you some rundown on
Yeah,
what we
thanks.
do?
I think that there has been a change in the way that benefits, they're probably not as freely as available as they were some years ago, even though it was even difficult then to claim them. You can't always fall back on the state, and many people who have lost their homes more recently in the recent years have realised that because of the very strict rules for applying for benefits.
So we can give you some background on the nature of the job centre, how we work, and what services we can provide for you.
Okay. Obviously, what I'm most worried about is whether or not the mortgage is going to be covered.
Several things affect your eligibility for mortgage relief and income support in general. For example, if you have a partner who works over 16 hours a week,
Right.
you would not then qualify for income support.
Income support is a means-tested benefit, and it's paid to people who are not in work or are working less than 16 hours a week and who don't have capital of over 8,000. So if we take the scenario of Simon, if his partner was working for less than 16 hours, so just doing a part-time job, they could claim as a couple income support, and any children would be included in that calculation. If they had a mortgage, then the part of that mortgage for mortgage interest would be met by the DSS.
I've just been across to the job centre and they've sent me across here to sign on. What do I have to do?
Right, we have to make you an appointment for a fresh claim.
Right.
Okay. Are you able to come in on Monday?
Yeah, that'll be fine.
Okay, can I have the name, please?
Yeah, it's May.
Is that M-A-Y?
Yeah, M-A-Y.
Thank you. Okay, what we have to do is get you to fill this out.
Right, is that a UB40 or something? Or?
No, you get your UB40 when you have your appointment for your fresh claim.
Right,
okay.
yeah.
This gives background details that need to be filled in before.
Have you any idea how much I'm eligible for?
It's approximately £44 per person. Okay.
What's that?
It depends per week. It depends on your circumstances. Yes.
Right. Okay.
Family credit is a benefit that's paid to couples who are in work and working more than 16 hours a week, perhaps earning very, very small amount of money, but also that they had children. You have to have a child to qualify for family credit, which is a top-up benefit to top up people's wages. However, in family credit, there is no allowance for mortgage costs at all. And it is a poverty trap for people that are caught in that situation. But if they're in rented accommodation, however, they could actually apply to the local authority for housing benefit. So clearly a benefit that is not very suitable for people who are homeowners.
So that's what you're entitled to or not entitled to if you're made redundant. But what if you're off work through sickness or forced to take time off to care for a poorly relative?
There are a number of benefits that people can get for incapacitation, and it may be depending on what's actually happened. For example, if there was an accident at work, there will be industrial injuries benefit. There are also other long-term benefits for people who are ill. Generally speaking, they start off on something like sickness benefit. They may get statutory sick pay from their employer, and this will lead eventually to invalidity benefit if they are long-term sick. If they eventually have to claim income support as well, because of their illness or disability, the rates for income support for people like that are much higher. And to take somebody who's actually got credit debts as well, certainly when we negotiate with creditors, if there is some illness, then that's something that we always tell creditors about. And if it does look like a long-term illness, and in some cases, we do have some cases which are terminal, then we do get write-offs of debts, because it's much better the creditor knows that this situation is not going to improve. People who are unable to work and who need extra care in the community can get disability living allowance. People who have to stay home and care for those people may be able to get something that's called invalid care allowance, and they should be encouraged to look into those benefits. Disability living allowance is actually paid to the person who needs the extra support, where invalid care allowance is actually paid to the carer.
Shopkeepers can't take out of a till what hasn't been put in, and so it is with the family budget. You need to work out precisely how much you've got coming in and how much you've got going out.
Sit down and work out exactly what your monthly, quarterly, annual bills are going to be. And don't forget the annual bills like your TV licence, the house insurance, the road fund licence, any subscriptions that you may belong to. Add all those together and it's a horrific total when you look at what your year's commitments are. Divide it by 12 and then set aside each month, preferably in an interest-bearing account, either with a bank or a building society, the equivalent of those 12 months. Now that means that if during the period, because some of those are annual bills and you're not going to have to pay them until you've been saving for nearly 11 months, which means that you've always got a small reserve to call on in the event of a minor catastrophe.
So assuming you do your budgeting properly, How do you avoid being fleeced? How do you keep control of your money when it's in the hands of the high street banks, some of whom charge what seem like exorbitant rates?
Over 95% of the population of Britain have a bank account. 52 million current accounts, 18 million deposit accounts. And when you think about it, you've got to think that money is just a commodity. Like a greengrocer sells apples, a coal merchant sells coal, banks sell money. You've got to be prepared. If you're going to borrow money, you've got to be prepared to pay for it. And on a reverse basis, if you give money to the banks, then you must expect some form of return for it.
The strange irony of money is money attracts money. And therefore, if you've got it, you can make it work for you. And if you haven't got it, it always goes in reverse, and it costs you money to have it. Banks have money, and they will always lend to people at a much higher rate than they will pay to their depositors. They will normally charge anything between 1 and 6% over their base rate. They will usually pay between 2 and 4% less than the base rate. Therefore, their margins are enormous.
I don't think banks charge too much. We have to provide that money. We have to have that money. If you've got a current account, the banks can't invest that money to earn interest long term. They've got to keep that money there, available for you to draw at any one time. If everybody was to draw, tomorrow was to draw on all their checkbooks, then Britain's banks have got to have the money available in their central account at the Bank of England to meet those bills.
If you're living within your means, in other words, you're not often using an overdraft with your bank, you should certainly make sure you're in one of these current accounts that pays some interest. And go for the best one you can find, basically shop around. If you know there are going to be times when you're going to want to dip into a bit of overdraft, the best value you can get from your bank is to tell them that. Get an overdraft arrangement agreed. And some of these accounts actually allow you a free £100 overdraft or something like that. So again, shop around to see if you can find one of those. Make sure the bank knows what your overdraft requirement is likely to be, because it is so much more expensive to go into unauthorised overdraft, because the interest you're charged on the borrowing shoots up, added to which you usually get hit with a penalty for going into the red without permission. You know, the bank manager writes to tell you the letter costs 15 quid or 20 quid or whatever it is, which is the last thing you need when you're already in debt that you hadn't intended to be in. So a little bit of planning to get the best deal out of them.
I think the answer always is to keep the minimum amount that you need in your bank at any one time, and for the balance of that money to be placed on either deposit with the bank or in a building society, so that it earns interest day to day and week by week, and monies are only transferred into your current account as and when they are needed. Normally the largest payment out of anyone's bank account is their mortgage, and the mortgage goes out on a certain day, and that's the day when the money should be in the account. Otherwise, for the rest of the month, the account should be kept as low as possible, but obviously enough in the account to meet the day-to-day transactions. Otherwise, the bank will take great delight in bouncing your cheque and charging you £25 for the privilege.
Ever read a paper like this and wondered, what's it all about? These stocks, shares, gilts, bonds, securities. What are they? Where do you get them? How much do they cost? Could you make a fortune, or could you blow the lot? What about if you had quite a bit of money to spare? Where would you invest it?
Post office.
In the post office?
Yeah.
You wouldn't be attracted by a building society?
No.
Why not?
I don't know, I just like the simplicity of the post office.
Spend it.
Would you? What on?
Probably a holiday, clothes, perfume. I don't know, I spend it, yeah.
Building society.
Why would you put it in a building society?
because I like my book. In the bank you just get your statements, and in the position I'm in at the moment, I like to see what I've got, I like to pay my money in and see what's there. Get a book. With a bank you just pay it in, you just get a little slip.
Would you not be tempted to invest in some stocks and shares, which would give you a much higher return?
No, I've done that. No, thank you.
Why do you say no, thank you?
A few years ago, I tried that, and I come unstuck, and I wouldn't do it again. No way.
Too much of a gamble?
Absolutely.
Well, I'd get rid of my mortgage for a start.
Yeah.
And then I'd put it in building society, and then give it to family and friends.
Why do you think why would you choose the building society? Why does that appeal to you?
Tradition.
Tradition?
Tradition for me, and just a sense of security.
What would you do if you had some spare money to invest? Where would you put it?
I've never been in that situation. Where would I put it? Probably somewhere awfully boring but reasonably safe.
Like, for example?
Oh, I don't know. It wouldn't be a stocks and shares type thing. It would be a bank, a building society with a guaranteed return.
So you're not a gambler?
No, sorry, I'm a boring old fart. Am I allowed to say that?
What you can do is to save a small amount of money on a regular basis. When you go to your supermarket, some supermarkets, or certainly the one I go to, I buy £1 worth of saving stamps every week. And at the end of 30 weeks, I'm going to have £30, which I'm not going to have noticed coming to me. I haven't noticed spending that money. And at Christmas time, that's my Christmas expenses catered for.
If you're just putting aside a small amount each month, you really want to look probably at the most tax-efficient way of doing that. And one of the best ways is to open an account with a friendly society. People don't realise that you can put about £20 a month aside on a regular savings plan, and it's a completely tax-free investment.
Don't think that because you can only afford £1 a week, it's not worth saving that £1 a week. It is, because if you start off for the first year saving £1 a week, most people get an increase in salary or wages on a regular basis. You'll find the next month, because you've got into the habit of saving becomes easy.
If you're putting your money with the building society, you're lending it to them to use, and they're going to go off and lend it to somebody else to buy a house and charge them lots of interest. So, you want the maximum out of them you can get. The higher rate accounts do tie up your money for longer. They pay you more interest because they know they've got your money for a year or 5 years. You're not about to come and draw it all out, and therefore they pay you a bit more. If you're running a current account, you may be getting a little bit of interest on that, but it is only a little bit, because you can take that money away any day of the week. They never know how much is going to be in your account, whether you're going to draw it all out, and therefore they only pay you a little bit of interest.
Have you ever heard of a scheme called TESSA?
Yes.
Do you know what that is?
Yes.
What is it?
It's some sort of account you put your money into, and you can't take it out, but it has a very good interest rate, and then you have to put a certain amount of more money in so many more years later. Is that right, in a word?
Really, I think I might rather invest something in a TESSA or something like that.
In a TESSA?
Yeah.
Why a TESSA?
Well, the tax advantages.
TESSA is this sort of wonderful acronym of something called a tax-exempt special savings account, I think. And it's designed to encourage people to save when the government got a bit worried about the fact that people didn't seem to be saving very much money, which was causing all sorts of problems for the economy. And to encourage you to save, the interest on the money you're setting aside is totally tax-free. So you can be as rich as Croesus, but you can still have one of these things, and the interest on it is tax-free. And the rules that have been in operation for a while, which are subject to change, of course, but allow about £9,000 to be put in over the 5-year life of these things. But you can't put it in all at once. You can only put it in chunks, and the chunks vary. It's sort of so much up front and then so much a year until you hit the ceiling of 9,000 or whatever it may be.
What about PEPS? Do you know much about that?
What's that? Public employees? No, I don't know.
You don't really
know?
No. Do you know what PEPS is?
It's apparently a safe place to put your money, isn't it?
Yeah. But you don't know what type of scheme it is?
No.
Have you ever heard
of
of
a government scheme,
The other sort of tax break, which is tax-free investment, which is a shorter-term thing in a sense, is the personal equity plan, where your money's going into shares, ultimately. And that you're allowed to put in quite a lot of money every year, £6,000. And in fact, you can also put £3,000 into just the shares of one company and have a second separate PEP, as they're called. And now that, all the dividend income and the capital gains are totally tax-free. And you can move your money around very easily and very quickly, and that's every single year you can open these things. The reason it has to be like that is because if the stock market is moving around dramatically, again, you don't want to be trapped by government rules into not being able to sell your shares when the time is right for you to do that. So you have to have that freedom and flexibility.
The best thing would be with stocks and shares, from what I'm told.
You wouldn't be concerned about the risk involved in stocks and shares?
Well, there's all an element in risk in everything. The rates going up and down just in today's circumstances with the way things are. So with stocks and shares, if you're looking over long term, I think in the long term it would probably do you better.
Share. You buy some shares?
Yeah.
Why would you not be bothered by the risk of buying shares?
No.
No?
I like it.
You like a gamble?
I like risk.
Yeah?
Yeah. No gain without risk.
At the moment, the stock market, if you've got the courage.
Most people have bought the privatised shares, British Telecom, gas, water and all of that, because the government was virtually giving them away and you'd have been crazy not to buy them because you were getting something for next to nothing. But that's not really the reason why normally you would invest in shares. Shares should be seen as a reasonably long-term investment. It's investment, not saving. You can lose the money if the company whose shares you bought go bust. So you have to be careful about what shares you select. Now with water, electricity, British Telecom, these are big, solid, profitable organisations, so you're not going to lose your money. You are probably going to make money because over time those shares will go up over several years, hopefully. And in the meantime you get an income because you get a dividend that's paid twice a year. Very nice, thank you. And the reason for buying shares is that ultimately you're looking for some income and capital growth. And the shares you select will reflect whether what matters more to you is that you should grow your capital or that you want an extra income. And if you want an income, you pick a share that pays big dividends so that you know you've got that income coming in twice a year. If you want capital, you pick perhaps a share in a smaller company that's growing fast, therefore isn't paying a lot in dividends because it's reinvesting that money in its own business and developing and growing. But of course the shares are going up and up because the value of the company is increasing all the time. I mean, shares always fluctuate and they can fall quite spectacularly sometimes. So again, if you're buying shares, you need to do it with money that you're not likely to want to get out in a hurry. So that if the stock market does crash, you can just sit there and you can wait until things get better. And you're not a forced seller at a time when prices are low. You know, if you don't have a lot of money, it's expensive just to buy a few shares in 2 or 3 companies because of your dealing costs and so on. So you probably want to go into something like a unit trust or an investment trust. And they are similar sorts of things in that in each case, all the investors' money is pooled into one big pot. And then that pot is used to buy shares, not necessarily just in this country, but abroad, gilt-edged stock, other governments, loan stocks, and so on. And perhaps even, you know, to invest a little bit in currencies as well. And you're getting the benefit of an expert manager, you hope, across a wide range of things, which also reduces your risk, that you're not just in, you know, again, Bloggin's company, which may or may not do well, but you're right across the spectrum. So if Bloggin's doesn't do very well, it doesn't matter because you're also in all these other things that are doing just fine. With a unit trust, what you do is you literally buy units in the fund, and those you can buy, again, through an advert in a newspaper or a magazine or direct from the fund. You don't need yourself to go to a stockbroker and go through the stock market. When you're looking for advice, there are 2 sorts of people you can go to. One will be an independent financial advisor who looks at the whole range of products and will try and pick the best one from right across the marketplace for you. And the others are people who are tied agents working either for a particular organisation or linked to them in some way, who will only be advising on that organisation's products. Now, they may work for more than one organisation whose products don't clash but complement each other. And they have to give you, by law, the best advice on the products that they look at. And if one isn't suitable for you, they're supposed to say so. the independent financial advisor is also supposed to give you the best advice he or she can, but he does have the whole market to look across. And the way they are paid also is slightly different, in that the tied agent is drawing a commission from selling you the product. He's paid a commission by the insurance company or whatever whose product you've bought, whereas the independent financial advisor will either receive a commission, which he should tell you about, or he may charge you a fee. Now, if you're paying a fee, you know you're getting really independent advice. And the other very good rule is, on the whole, if somebody's selling you a financial product, don't write a cheque to them, to Bloggin's advisor. If they're selling you a legal and general policy, that cheque should be written to legal and general, because they're just passing it on. And that way, if something goes wrong, you've got a big organisation that you're dealing with. You'll be all right. Whereas if he's a tin pot little outfit who might go bust tomorrow, and if he goes bust before he's passed your money on to legal and general, you've got a real problem. I mean, you would in fact be covered by the Investors' Compensation Scheme almost certainly, and you would eventually get money back, but it could take a while.
How you manage your money can also depend on how old you are and your personal circumstances. What's good financial advice for a married couple would not be good financial advice for a pensioner. And you have to think differently about the best way to provide for youngsters.
If you're under 18, you cannot contract for a debt under English law. That means you can't borrow money. In that case, you don't need a credit card or a cheque guarantee card. You need possibly just a deposit account and maybe a cash dispenser card to draw that money through an automatic telling machine or ATM.
It makes good sense perhaps for a child to have a savings account that their parent or grandparent can put some money into, because that child's going to get the interest completely free of any tax. If it's a building society account, you do need to fill in a special form confirming that the child is entitled to get it free of tax. And that is using the tax allowance. You know, if you're not earning anything, you can't use your tax allowance. If you're not earning enough, you can't use the whole of your tax allowance. You don't get the money back, as it were, from the government pot. So you want to make as much use of it as you can.
Therefore, places such as National Savings Bank, savings certificates, some building societies and banks now offer gross funds for children's accounts. These are the best places for funds to be invested so that they get the maximum use of their money, maximum use of interest rates, and pay no tax whatsoever.
If you had some spare cash, where would you invest it? Or what would you do with it?
I've never been in this situation. It's beyond my experience.
As far as students are concerned, normally they have a very limited amount of funds available to them, either grants or monies that they've been given by their parents to enable them to live for their year at university. And therefore, again, they have to invest their monies in the most tax-efficient and highest rates, but they do need their monies for their board and lodgings and books and whatever they need for school. And therefore, again, building societies are probably the best for them because interest is paid to them at a rate which is usually beneficial. They can invest it in tax-free funds and they can gain instant access.
If you know you've got some heavy spending at the beginning, just do be sure you don't run out of money by the end, so that you know you're going to spend £200 or £300 straight away in the first 2-3 weeks of term. Try and make sure that whatever's left is something you really can live on. And if it isn't, you know, get that bar job sorted out, or whatever.
Whilst the banks have a perceived generosity in terms of the overdrafts and loans which they're giving to students, my belief is that they are heading the student towards a very rocky road and teaching them bad habits before they even put their foot on the first ladder in terms of their employment. They're giving them loans which they have to repay at some point, and if the student is a long-term student or if he can't get a job immediately following university, he has a very difficult problem in repaying those monies back to the bank. And sometimes banks can be extremely hard on individuals if repayments aren't made within the due times. They are charging rates of interest which are beneficial to the banks. The banks are in business to earn a profit. They are not charitable institutions. They're not so happy to write off loans, and they certainly want their interest.
The first salary usually arrives after you've already been in the job for 3 weeks or something, and is probably just going to clear overdraft. So the first thing to do is actually, if you've got an overdraft left over from student life, which you almost certainly will have these days, is to work out how many months you want to reduce that overdraft by. I mean, do try and get it down either completely, because then you've got a good record with your bank and they love you for that, and they'll lend you more money next time. So plan a little bit, that you don't spend the whole salary every month if possible. Even if it's only 10 quid a month or something, that you're reducing the overdraft in stages all the way down if you possibly can, and sort of till you've got that off your back. You may need to go and spend some money on a suit for work and that kind of stuff. I mean, that's a sort of sound investment, really. That's something you may well have to spend a bit of money on up front. So again, you may need to think about that in terms of how you're managing any overdraft or debt you've got. Or if you've got your first credit card, which you may have had one as a student with your bank anyway, because they do give them to students. But if your credit card limit has now gone up or something, it's worth remembering that normally it's cheaper to spend £200 or £300 on your credit card if you know you're going to clear that within 3 or 4 months than it is to borrow that money from your bank on overdraft. The best way to save, which you're probably not that keen on thinking about as you start your first job, is actually to go out and start a pension plan, because it's fairly painless at that stage, because the younger you start it, the less it costs you each month to build up the size of pension you're going to want at 60 or 65. Whereas if you leave it till you're 30 or 40, you've got to put aside a lot more money each month. Now, okay, then you may be richer, but in fact, if it's only going to cost you 10 or 20 quid a month at 20, you might as well do it, because the benefits, it's all tax-free. The benefits are so great, and it is a form of saving, and at least you've got that.
If you had some cash to spare, what would you do with it?
At the moment, building society.
Why a building society?
Having just taken a big sting on my house and being unable to sell it, I'd feel safer putting it in a building society than anywhere else.
I'd just put it in the building society.
Why do you choose a building society?
Because I've always had a building society account.
Once you're married and kids on the way or kids actually there, all of a sudden your life takes a different turn because you have responsibilities. You can't be the selfish person that you were, spending monies on the things that you wanted for the short term. You have people that are now dependent and relying on you to put bread on the table, to put a roof over your head. And therefore, the manner in which you must conduct your financial affairs take a very sharp left turn.
Children are jolly expensive, and you do need to sort of start to plan for them. I mean, it's not just that they grow fast and need more clothes. I mean, there's the whole question of schools, school uniforms. I mean, leaving aside the whole issue of private schooling, whether you can afford to go for that or not. School holiday trips, all of these things add up, and then all the fads and fashions that they want to go for. So when the child arrives, or even before it arrives, it's a very good idea to start some sort of savings plan, either of your own that you will then tap into for these expenses, and or one for the child. I mean, get the doting grandparents and aunts and uncles to put some money into an account for the child.
You must make sure that you have some sort of policy that if you are sick, ill or made redundant, that there's adequate funding to pay for the outgoings of your home, your house, your mortgage, to enable the normal routine things of life, the gas, the electricity and the food bills to be paid. Your children need you in more senses than just the love and affection. You must make sure for them that they are secure for their finances for the future.
If you've both got separate savings accounts, you do both have your own personal allowance. You will need to make a decision about what's happening to the married person's allowance, which one of you is taking it, whether you're just sharing it between you and so on. So you need to do a little bit of tax planning and juggling there as well. If one of you is earning a lot of money and the other one's earning very little, you might want to make the deposit/savings account in their name so that you're making use of their tax allowance, because the person who's earning their tax allowance is already fully used. But again, that involves quite a degree of trust, because if you put all your assets in your wife's name, that's really in her name, and if she decides to run off with the milkman, you're stuffed, basically. So you have to watch that. So again, joint accounts, separate accounts, it really depends on how much trust there is between the two of you, and that varies from couple to couple.
It makes sense to have a joint account, so in the event of either of you dying, at the worst possible, or going into hospital, or going abroad and not being available, you can actually access that money. In the event of a dispute, a breakdown in the communication, in the relationship, it's best for both parties to inform their bank that there is a problem, so that the bank manager can sit down and work out who should have what out of the account. It's an uncomfortable situation, but it's best to do it as soon as you're aware of a problem.
There's no reason why you shouldn't both have a separate savings account as well, for, the fact that the husband may have a hobby that the wife's not interested in, so he can bung aside a bit of money in that, and there's no argument if he wants to blow it all on whatever, and the same for her. So you just don't argue about that. It's been set aside and that's it. But for household practical things, a joint account is pretty sensible. The only thing you need to watch is things like bank guarantees if you've got a joint account and one of you's going into business or something. The bank so often wants the spouse to give a guarantee or whatever, and you may not want to get trapped in that, because if something goes wrong with the business and the marriage, the other half can find themselves faced with the entire debt that the spouse had, and that's just not funny.
What if you had some money to spare? How would you invest it?
Well, if it was a lot of money in property, probably, although it goes down at the moment, it will come back up.
But I do like gambling.
You like gambling, but you wouldn't gamble your own money on stocks and shares?
On the 2 o'clock at Newmarket, but not stocks and shares.
I mean, as you go through your sort of financial life cycle, and by the time you get around to the house and the children, you will also have thought about life insurance, and you should have planned your pension, so that as you're getting into your 50s, hopefully the children are growing up and going away. They're no longer a big expense. Your house should have gone up in value. You're not perhaps quite at the point of having completely paid off the mortgage, but you can see that day coming, which means that you're then going to have this asset that's unencumbered that you can sell or do things to, whatever it is. It's no longer a drain on your resources. But at that age, you may well want to go on saving. Perhaps you've developed some extravagant habits by now. You want to be able to buy expensive wines and go on ritzy holidays. Maybe you haven't really been able to top up your pension as much as you would have liked to have done, because all the money's gone into raising the kids. You've been in debt since you were 25, and suddenly you're about to stop being in debt. It's a wonderful feeling. And that is probably the point at which to look at your long-term savings, like your pension plan, just to make sure that they're going to keep you to the, in the lifestyle to which, if not already accustomed, you're planning to become accustomed. And now you've got some spare capital, some spare income perhaps the capital's still tied up in the house, and you can do that. So that's why people at 50 odd are still saving, just to make sure that their old age is comfortable. And people are living longer, so in fact at 50 you may well going to stay alive to 80 or 90. So you've got to think about whether your pension provision is going to mean that you're reasonably comfortable up to age 90, or whether you're going to be living in a cardboard box.
There are nearly 10 million pensioners in Britain today, living on less than £60 a week if they're single, or £90 a week if they're married. Some also receive what's known as SERPs. That's the State Earnings Related Pension Scheme that tops up their state pension by as much as 25%. Others have contracted out of SERPs because they've got a company or individual pension that's better.
Thank you. Now, can I have 2 television stamps, please?
If, like a lot of pensioners, you're hard up for cash, then you might want to borrow. But beware, it's going to cost you. There's no such thing as easy money.
People are now finding it quite difficult to get credit, but that situation may change again when the economy changes. And the easy lending practices that we saw in the 80s will actually come back again. And I think it's important that lenders don't do that, and that people and everybody is educated in using credit.
Throughout my entire life as a bank manager, I don't think anybody has ever asked the question first, what's it going to cost me? They've always said, I want to borrow £5,000. When can I have it? And it's the vision of the goods or the services or the holiday or the wedding or whatever, rather than, can I really afford to borrow this?
A credit card is a wonderful thing to spread your bills if you know you're going to clear it off in full every time. And that's worth doing. And then you can, then you know exactly where you are. And that's why some of them now charge an annual fee, because otherwise they weren't making any money at all. The other thing to look at, of course, is a charge card where you pay a much bigger annual fee. You don't pay any interest, but you have to pay it off in full every time or you get into difficulty. So there are those two variations. But really, they're all tools to be used to spread your funding. So if you know you've got a big piece of expenditure coming up, like a sofa or a holiday or something, if you can bung it on the credit card and pay it down over 2 or 3 months, it's actually quite a cheap way of borrowing the money. If it's going to take you longer, then talk to your bank.
Some people who would be considered by all accounts a very good credit risk would be unlikely to get the credit. For example, the local vicar would be very unlikely to get credit because his job will be tied to where he lives. You know, if he loses his job, he loses his home and so on. So he would not be considered a good risk on a credit scoring system. But if you own your own home, you get more points. If you have lived there for a long time, you get more points. If you've got other credit agreements which are running satisfactorily and credit cards, you get more points because it means that you're credit wise and that sort of thing. And so the credit scoring system of deciding whether or not you get credit doesn't use credit reference agencies. But these days, the majority of lenders will use both. They will use credit scoring and they'll check with a credit reference agency. Now, once the information at a credit reference agency is stored, it will stay there generally for about 6 years. That's good and bad information. If the information is wrong, you can get it changed. You have a right to see a copy of your file. And if you write to the credit reference agency and send a fee of £1, they must send you a copy of your file, and they must do that within 28 days.
Don't be tempted to go to a money lender. Don't be tempted to borrow money from those people who advertise in some of the newspapers, who say tenants accepted, people with county court judgments accepted. Be very, very careful of those sort of adverts. Those people are going to charge you 3, 4, 5 times what the banks charge you. There is no law in Britain which says there must be a maximum interest charged on the money you borrow. You're going to pay more if you borrow from a store, on a store card, than you do from a bank credit card or a building society credit card. The highest annual percentage rate of interest I ever came across was a staggering 4,000% per annum. And that was somebody who had borrowed money from what is basically a loan shark. He'd signed a valid legal credit agreement for something like 40%. What he didn't realise, because he didn't read the small print, was it wasn't 40% per year, it was 40% per day. And it mounted up to 4,000% per annum from a loan shark. Don't go to loan sharks, go to banks.
There are only 2 things that are certain in life, which are death and taxes, and unfortunately neither of them will go away. The taxman will definitely not go away, and he wants you from the minute you're born to the minute you die, and after you die as well. And the only way that you keep him happy is by making sure that you give him the information that he wants and that you pay your tax on time, and that the declarations which you make to the revenue are, to the best of your knowledge and belief, correct, and you organise your affairs in such a way that the revenue cannot criticise you or investigate you in what you do. There's a big difference between tax avoidance and tax evasion. And tax evasion is simply an individual not declaring a source of income, deliberately and maliciously not declaring a source of income. Tax avoidance are by taking the legal route of not paying as much tax on your income as an individual who does not take those steps. Tax avoidance doesn't bear any penalty. Tax evasion can have very serious consequences, including large payments for interest and penalties if the revenue take on investigations.
Meanwhile, Overspent, out-of-work Simon is still surviving, and the postman that brought him such bad news before now brings him word of his salvation.
More bills for you, Simon.
Oh, great, thanks. What? What's this? Oh, yes!
What would you do if you suddenly got rich?
I don't believe it! We won! We won!
I have a very stiff drink. And then I'd put it initially all on deposit with my bank or building society to give myself time to think about it, and put it into an account paying a reasonable amount of interest. Don't tie it up immediately in something that means you can't then get at the money for a year or 5 years or even 6 months. Just bung it in a, some sort of interest-paying deposit account where you can have access to the money quickly when you've made up your mind what to do. So you know it's safe, it's earning a little bit of interest while you've got time to think. And then, then the fun starts. I mean, the golden rules are basically, spend a little and have some fun, but don't spend it all.
I would invest some of it abroad, using a medium of a bank or investment house in possibly Switzerland or Luxembourg to invest it outside the United Kingdom on bonds and investments and managed through a bank overseas who have a different investment mentality to the UK. I would invest some of it in traditional ways in the United Kingdom, secure and safe, building society bonds, insurance bonds, maybe some property investments if they're bought right with the proper advice, and then to take a larger risk for a higher reward and invest some of it on the stock market. And remember that the stock market does go up and down and that not every share is a winner. I would then take a proportion of it and ensure that whatever happens, I know that I have got a secure amount of income and capital which will last me for a long time, and that I shall never have to want for anything in terms of my capital, that I don't go and spend it all immediately. Have a good time with it, but keep the balance going.
Can I help you?
Whatever your financial fortunes, the best and most basic advice we can offer is to think hard about what you're spending. Ask yourself, can I really afford it?
20, 30, 40, 50.
And wherever possible, don't be afraid to enlist the help of an expert.
Go and see a financial advisor, sit down, and don't just talk about what you need now. Talk about your life plan. Now, if halfway through your life your plans and ambitions change, that's fine. You go back and you see them again, or whoever it is, and you draw up a new plan. After all, businesses do this all the time. They have 2-year plans, 3-year plans, 5-year plans. So should people, because your requirements do change as both as you age and as you suddenly decide you're going to go off and sail around the world or start your own business and all of that. So you need to revisit the subject from time to time on a regular basis. But you should, every time you make a financial decision, you shouldn't take it just in isolation. You should take it in the context of other things. And instead of letting that be off-putting and thinking, oh, it's all too much to think about, keep it simple in terms of what do I want to do with my life? Where do I want to be in 5 years' time? Where do I think I'm going to be in 5 years' time? And then that immediately gives you a context in which to make the decisions about the here and now.